focus this morning. But just about 5 seconds to go for the markets to open today. Last trading day of the week, and it's not looking great actually. Down about 100 points straight off the back on the Nifty. The Sensex is down 300 points. What's leading from the front on the downside? Reliance is just struggling for the last many days. In fact, once again, the top Nifty loser this week, down about 4%. So things are not looking good there. Hindalco, LTI, Mindtree, Tech Mahindra. So IT in general has moved to the back burner, whether it is Infosys, Wipro, Tech Mahindra, all in the red right now. Grasim is down about 1% as well, and Divi's Labs, ICICI Bank, HUL, a couple of other stocks that are in the red as we speak. The market has started with a cut of around 119 odd points, 120 now. The Sensex is down 450 points, and not a good opening at all for the bulls, led largely by the global, weakness. The Bank Nifty is now down almost 300 points. But what's supporting the market today is a couple of names. There's NTPC, Adani Enterprises, Hero MotoCorp, Adani Port, and Britannia. So these are a couple of stocks that are just about holding on the green line. But otherwise, it is the market is definitely sulking. In fact, the advanced decline ratio is now well in favor of the declines. Over 1,000 stocks on the declining end. There are some stocks that are bucking the trend, like Paytm, Amber Enterprises, etc. Nigel will talk about that. But in general, it's a sticky start.
Well, it's a sticky start, Sonia. I just want to focus on Jio Financial Services, actually. There were close to around 17 crore shares in pre-open that were pending for sale. Close to around 5 crore shares have been picked up. So that number has come down now. So just keep an eye out on that. That number has come down to around 12 crores approximately in terms of selling. So there is a fair bit of action in pre-open itself. So keep an eye out on that one. A couple of other names gains. Well, it's entered into an MOU with the government of Karnataka for investment of around 3,700 crore rupees to set up semiconductor assembly and testing. So that's the reason why that one is up close to around 7%. The Defense Acquisition Council, they have approved proposals worth close to around $1 billion, which is beneficial for BEL. Also some kind of a rubber for Astra Micro as well. And by the way, Astra Micro, the reason that one is higher is because they received orders worth 158 crores. So that explains why that stock is doing well. Paytm, well, the large trade took place in pre-open, so that one's opened up in the green. Coforge, that was the big mover yesterday. Bearings has exited. 26% is what they sold, and that one was up close to around 10% by the time we wound up yesterday. So that one is in focus. Universal Auto, I don't know whether we have that stock. Very, very small stock. Nimesh had told us yesterday an influential investor could be, buying into that, and they bought. Ashish Kochole has bought close to around 16% odd, but very small company out there. The record date for some of these buyback names as well. Let's see how the stocks are reacting. Piramal Enterprises. Today's the record date. Yesterday was the last day to buy, to be eligible for it. So the stock ended at the low point of the day. So Piramal Enterprises should be one such stock. It's down close to around 2% odd because that buyback, those who were playing for buyback, they bought till yesterday. Today, in fact, it's not valid. So FTC is the other one as well. Some of these stocks, record dates is today. KRBL Limited as well. So let's pull up a few of them. And India Mart as well. So India Mart, all of them, in fact, a little bit lower because of that buyback support. Prashant, what else?
Well, so settling down, right? I mean, pretty close to the low that we had last week, which is 19,253. We are at about 19,266. That's about 120 points lower at this stage. Market breadth is still positive, I mean, mind you. I'm talking about the overall, about 100 stocks separate gainers and declines. I'll just look at a few other names on the downside to begin with. Let's look at Shoppers Stop, which is down, I think, 7.5%. That's coming in for some selling, 750 on Shoppers Stop right now. TVS Motor, there was that bike launch in Dubai yesterday, 1.33% lower on TVS. Stocks at about 1344. There's Bajaj Hindustan, which is down 2.5%. Wipro is starting about 1% lower. There is Zomato, which is down about 1.5%. Piramal Enterprises is the other one, which is down 2%, 1,035 on Piramal. And there is Ambuja Cement, which is down 1.5%. GMR Infra down 2%. So some of these are just kind of, are pulling back after what we really saw. On the upside, Paytm is up 2%. I think we highlighted some of this earlier. Amber, blocks here. Suzlon is creeping up a little bit, again, 3% higher. Canes we spoke about. Keep an eye out on, Astra Micro, that's coming up with about a 3% gain. And go down the list, there are more names, but in the smaller. Supreme Industries made that acquisition. Stocks up about 1.5%, but it's just kind of gone one way, Supreme Industries, for the last many days now. So Overall, it's a down market as expected, but in the broader market, gainers still slightly ahead of the number of stocks down.
I just want to make one mention on a pocket. Remember, we were talking about this whole home improvement theme and the polycabs, the APL Apollo tubes of the world.
Yeah.
Today, Cera Sanitary Ware is the stock that, it's had a fabulous run. I mean, that stock, Cera Sanitary Ware, is up 72% this year and is sitting at a fresh 52-week high. So I know the market is really volatile, but there are certain pockets which the street definitely is latching onto.
1% or higher on Cera as things stand right now. Well, Gautam Shah is founder and chief strategist at Goldilocks Premium Research. Gautam, good to have you with us here. Thank you very much for your time. So we got you on a not a big day, but on a down day. So we're down 100 points, Gautam. How are you looking at the price action over the last couple of weeks, and what do you make of it? What's the assessment near to medium term?
Good morning, Prashant. Well, I think we've gone through a very unique correction in the last 1 month. There was this euphoria around that level of 20,000 on the Nifty last month. You had a scenario wherein just about everything was doing well, large caps, mid caps, small caps, all at the same time. Indian markets enjoyed a lot of tailwind. Global markets were very steady. And I think that euphoria pretty much triggered this correction, which was much needed, because I think the month of June and July saw a phenomenal, almost a vertical move up. But I think, as I said, this is a very unique correction because the Nifty is fallen about 700, 750 points. But the beauty is you have the mid-cap index, which was at lifetime highs yesterday, and the small-cap index, the small-cap 100 index, hit a level of 12,000 yesterday, which was also a lifetime high. So I think this is a market about stocks. I think we have been maintaining this right from the start of this year, that the index will not do anything special. It will go through its correction phases from time to time. But I think sectorally, theme-wise, I think there are immense opportunities, and this trend is going to continue. So really, it's just the top 100 which have been impacted. Aside of that, I think this market continues to be very, very strong. Also, I do believe that this is just a normal correction. 19,300 has held out so well in the last 2-3 weeks. If this number were to break, you might see an attempt into that 18,900, 19,000 zone. But anything close to 18,900, 19,000, I think the market becomes a buy, and we hopefully see a turnaround very soon, leading to a move back to 20,000 and beyond. So the short medium term view remains bullish. It's just that the index is going through that difficult corrective phase, which I believe closer to the end of this month should get completed.
Okay, that's great to hear, Gautam. I think after a while, I'm hearing you get so bullish on the market, right? If I'm not wrong.
No, Sonia, it's just after we've been talking after a while, and I think in between so much has happened in the last 2.5 months. And, the mid-cap, small-cap space, there's so many themes and sectors have done so well. So, there's nothing on the charts in absolute terms that tells us that the markets are weak. After all, we've fallen 3% from the highs. If you compare India versus the world, India versus US, India versus Europe and the rest of Asia, our ratio charts have been in an uptrend all along. So no complaints, honestly.
So, the reason I'm asking you, Gautam, is because, this is the time when the market is sort of stalling a bit, right? It could perhaps be just taking some time out before the next leg of an up move. But what do you do at a time like this? And what are the, markers on the upside? I heard you mention 20,000 briefly, but by the end of the year, where do you see the Nifty?
I was very optimistic yesterday because the Nifty was making an attempt to get past that big resistance of 19,600, but it faltered. And today we are back at the lower end of the range because this 19,300, 19,600 band has pretty much been a pendulum in the last, a month or so. And once the Nifty gets past 19,600, I think the uptrend will resume. And then we are looking at 20,000 and possibly 20,400. Unfortunately, I do not have big numbers to work with beyond 2,400 because I think it's a sort of an inflection point. But any which way, I think that, as I said, this market is about themes. So we continue to like the pharma space. We love the way the IT space has come back in the recent past, despite all the negative talk and the headwinds, coming from global markets. And I do believe that the IT index is readying for a fresh breakout and could actually lead the market higher. And let's also not ignore the banking index. I think around 44,000, there is not much to lose on the bank Nifty. And I also love the way the PSU banking space is setting up at this point of time. So these 3 or 4 pockets that I highlighted, I think are the best opportunities as I see it, till the Nifty, goes through this consolidation.
All right. Well, Gautam, just request to just hang on. By the way, we have a bit of a recovery that's underway on the Nifty itself. We're 50 points off the day's low. Bajaj Finance, just pull up the intraday chart out there. Stock has done quite well. It's recovered from the day's low. LTI Mindtree as well as another stock that's doing well. And even Bajaj FinServes, there's only so much that they can do in terms of weightage. But that Nomura note that stated that, they have well-diversified liabilities. Exit of HDFC is a positive for Bajaj Finance, and also they believe the concerns surrounding, with the entry of Jio Financial Services are a little bit overdone. So both these two stocks doing quite well. Well, Gautam, always good to hear your thoughts, Gautam. I wanted to ask you about a large heavyweight stock. HDFC Bank, that's been a rank underperformer. Year to date, not done much. I think last 1 year, maybe last 3 years actually, from COVID levels itself, it's rallied the least. Now, that's the largest weight on the Nifty. How are things shaping up out there on the charts?
HDFC's bank has just become too big for the Nifty, for the bank Nifty, and for the overall market. And if this one stock does not do well along with Reliance, it becomes very difficult for the indices, the headline indices, to do well. And that's exactly what has happened in the last 1 month. But I think there was so much development around the merger. So I think it's all settling down now. There isn't much to lose. I think 1525 to 1550 is a rock solid medium-term support on HDFC Bank. And I want to believe that it should turn around from somewhere around these levels and probably go gradually back to 1750 to 2000. So we remain extremely bullish. It's just that it's going to take its time. I don't think these stocks can give you momentum. In fact, the top 50 stocks in the Nifty just don't have great momentum to do well. Whereas if you go outside of the Nifty, look at the NSE 500, look at the NSE Next 50, those pockets offer far greater value.
Gautam, so let's talk about stocks from that space and tell us a few stocks from a positional standpoint where there is money to be made.
So, Prashant, I spoke about IT. I think probably we're one of the few people on the street to have a very contrarian view on IT, because I think price correction was done with a few months back, and I think it's gone through time correction in the last 3 months. The setup is beautiful. All the negative news has been pretty much digested. The ratio chart of the IT index divided by the Nifty is at a multi-year low. And I think the chances of a turnaround from here is pretty high. And we've been betting on TCS and Tech Mahindra. I think we like both these stocks, and we feel that, they could lead the market higher, along with Infosys, which has actually come back very well after the, after the disappointment from the results. So IT is one space where I believe that there is a 10 to 15% move coming, which I don't see in any of the large cap indices. Aside of that, I think metals has been in our focus list. I think metals does not have much to lose. So you're looking at JSW Steel, the Tata Steels, the Nalcos, and the sales of the world. Very good chart structures, and I think they should rebound as well. And pharma clearly has been the poster boy of the last 3 months. This rally is going to continue because pharma came out of a 2-year-long bear market. So the opportunities, even from current levels, are quite immense.
Okay, one final question then. What would you do with some of these names in the banking space that are struggling a bit, right? I mean, of course, HDFC Bank is the poster boy of the struggling stock of the year. But apart from that, there are names like SBI that have come off about 10-12% from their highs. Do you use this as an opportunity to buy, or do you stay away?
We are extremely positive on the entire PSU banking basket. The PSU banking space in the mid-cap and the small-cap side has done very well. You might have seen many big winners. And if you see the PSU banking space, we see a multi-year breakout that seemed to have taken place in the recent past. So I see SBI rebounding from here. I see Canara Bank doing well. I see BOB doing well. And some of the other smaller names, which is usually a retail favorite, I think they should also continue to do well. So if you want to be focused on banking right now and till the end of the year, it'd rather be PSU banking.
Okay, Gautam, we leave it at that. Thanks a lot for joining in. Appreciate your thoughts. And that's an optimistic Gautam Shah on the market, saying that the short to medium term is positive. They're optimistic on the market, but the very near term, maybe a little bit of struggle is what you can see. But let's talk about the consumption patterns now, because TTK Prestige is the stock on our radar. The company reported a weak Q1 performance. The margins continue to be under pressure on the back of discounting, and in its conference call indicated that the demand environment remains challenging and they only expect a turnaround in the second half of the year. To discuss the demand outlook a little more in detail, TT Jagannathan, chairman at TTK Prestige, joins us now. Mr. Jagannathan, good morning. Always great speaking with you on the channel.
Good morning.
Hope you've been well and in good health. Sir, of course, in the conference call, you did mention that the demand trends are not looking great, but just wanted to understand in a bit greater detail, what do you mean by that? Where are you seeing the weakness emerge? And how long do you think this stretch could continue?
Actually, you have to look at this vis-a-vis last year. Last year, we had a fantastic year. First quarter, we grew 44% because we were just coming out of COVID and everybody spent money on the kitchen. This year, everybody is spending money on leisure. Every restaurant is full, every hotel is full, every flight is full. So the share of wallet for kitchen has come down. It's not something that's permanent or something that's worrying. It happened because last year first quarter was very good. The comparison is not very good. Even second quarter, but from the third quarter will look very good.
Hi, Mr. Jagannathan. Good morning, sir. In the last couple of years, the quarter two has been the largest quarter. You have done more than 800 crores in the quarter. How far off will it be? How much lower will this, quarter two be in comparison to the previous ones? Will it be anywhere close to that 800 crores or will it be much lower?
No, we're looking at 5% drop on that.
5%. So around 750 crores odd? That is doable for...
Yes.
Okay. And what about how are demand trends? Are you seeing some bit of a pickup? Inflationary pressures were there. Demand is
Festival buying has started and it's very encouraging. Very encouraging. But it reflects only in the next quarter.
So, in a proper way, things will start to look up and up only third quarter onwards, sir. Is that what you're saying?
Yes, Prashant.
Okay. And is there and you said it's just a very large base effect. I mean, in terms of actually what you're seeing, the pulse and feel of it, it's okay. I mean, things will come back. It is a normal kind of environment. There is no underlying pressure.
If you look at the line of CAGR for the last 5 years, we have grown year after year. The blip last year was because we did extremely well.
Okay. Yeah. So that base effect is there. We understand that. Mr. Jagannathan, I want to understand what's happening on the operational front because earlier you had guided for, I think, 15 to 17% EBITDA margin for the full year. Do you maintain it?
Yes.
Okay. You're maintaining that guidance. So the reason I ask is because discounting has also gone up and I'm sure with, with the spends reducing, consumption patterns dropping, and there is, of course, a lot of competition. Perhaps there could be some near-term pressure on margins as well, you reckon?
No, we do not discount. We only discount as to our plan. We don't disrupt the market at all.
Okay. All right. Mr. Jagannathan, it's good to know that margins will be in those mid-teens, 15 to 17%, but you're also guided for double-digit revenue growth. Is that still on the cards, going by the trends that you have seen?
For the second half, yes.
So for the year on the whole, what will it be? Flattish? First quarter was a degrowth of 8%.
Yeah, I would expect flattish.
So revenues will be in that vicinity of around 2,800 crores odd for the year.
Around that, yes.
Okay, got it. You give us some more clarity then. You're working on a premium brand. So I just want to understand more about that. Will you be launching it in-house or will you be acquiring it?
Launching it in-house.
By when?
I can't give you that number. I can't give you that date.
This is Judge, right?
No, Judge is the master.
The master.
Judge is not the premium. That's the lower end.
That's the
That's
master.
been launched.
So tell us about Judge then. That has grown very well. So what is the growth trajectory from here on?
Well, we're looking at fighting the cheaper brands. And like you said, it's doing well now. We'll have to wait and see how it plays out.
So, last few times we've spoken, you've been telling us that exports have been doing phenomenally well. That
Yes,
you've been having difficulty keeping up actually, and you've been diverting production towards exports. What's the situation now?
Europe has slowed down fairly dramatically in terms of their market, so they're stocked up. So there's a temporary blip again, but my customers have told me that it'll all get set right by December.
Okay. Okay.
So that would mean, earlier I think exports was 5% of your overall business. You were targeting to take it to 10%. Is that on track?
We'll get not 10, but we'll get it somewhere between 5 and 10.
By when?
By the end of the year.
By the end of the year, okay, somewhere between 5 and 10%. So you're saying that Europe is under pressure. Of course, for all industries, export markets have been quite tough this time. Any other markets where you are present, where you're still seeing some pockets of pressure?
90% of our exports are Europe and America. We do export some to the Middle East, but bulk of the exports are to Europe and America.
And how is America
Okay.
doing, sir?
Also slow.
Slower compared to
Yeah.
the previous two
Yeah, but
quarters.
they
And
all
that's again
believe,
because
my customers believe it will pick up.
by December, you said, right?
Yeah.
All right. Mr. Jagannathan, what is the average price of a cooker?
I have no clue.
No, because you have a new capacity at Uttarakhand, right? That's coming up, I think, with
Yes.
1,100 cookers per day. So I
Yes.
was trying to calculate the revenue potential from that. So, I mean, if you could give us that number.
And those are like stainless steel cookers, so they're a little more expensive.
Okay.
I mean, I'm still lost, sir. So if you could give me a rough range in terms of pricing, because we want to get to the revenue potential out there.
I'm guessing about 2,000 rupees.
2,000 rupees. All right. So just if I put in the math, this will be an incremental 70 to 80 crores approximately at optimum levels.
Yes.
Got it.
Okay, just one, niggling worry. Of course, I thought Nigel was asking about the price of cookers because he's out there to go and buy something for his own kitchen.
Even when I put that question, I was wondering, I was like, it's not sounding too right. But anyway, we got the number that we're looking at from a financial perspective. 2,000 rupees stainless steel cooker, and you get to around 80 crores also.
Okay. Sir, I have to ask you about the overarching theme, which is a slowdown in consumption. I'll come to that in a bit. But before that, just one niggling worry on this promoter pledge of 3.6% that was created. Why is that? And any change in the promoter holding at all?
No, in fact, we've paid up that pledge. We've now taken it back.
Okay.
It was a temporary requirement which we took, and now it's gone.
So the promoter holding will continue to stay at 70%, is it?
Absolutely, 70.48%.
70. Okay, got that. Just one final question from my end. You started by saying that consumption patterns are slowing, and that's also because of people are now moving out of the kitchen and sort of traveling, consuming outside. Do you think it could be a longer stretch of a slowdown? I mean, are you penciling that in as well in your forecast?
I would not like to use the word slowdown. We're comparing it to last year. Last year, we grew 40%. If you want to compare it to that, I don't think it's fair. I don't think you call it. There is a share of wallet that has moved from the kitchen to leisure. People are not going to be traveling all the time. It'll come back.
Well, they'll want home food, right? But beautifully put, sir. Thank you very much for your time. Great to have you with us here, and thanks for joining us with that perspective. It's always good speaking with you. Okay, the market's down, 70 points. So yeah, there is that recovery which we were talking about earlier. Just a quick look at things. Sun TV is the big mover. Stocks up about 4% or so. And, we're at about, 605, 606 odd rupees on Sun TV. Take a look at Canes, which has moved up even more. It is up 10%. There is, Astra Microwave, which is up 4%. KPI Green. Atul Auto is making a move. I mean, it's been a fantastic week for Atul Auto. It's up 25%. Friday 2 now, and we're not done with the day. So perhaps can do more. And there is a Green Panel and Sirma and so many other names which are coming into the mix as we progress into today's session. We'll take a quick break here. We are back with the management of Brigade Enterprises to discuss, what's happening in their business. Stay tuned. Coming up.
welcome back. Well, a couple of stocks are moving actually pretty well, though the headline index is down. And by the way, we've recovered a good 50 points from the low point of the day. The mid-cap index is now heading towards the green. It's down only around 0.1%. And various stocks are doing well. Genus Power making a fresh all-time high today. That's moved to the high point of the day. Indus Stars as well has moved a little bit higher. And I think Dixon Technologies as well, from trading in the red, that's turned around a little bit. Well, let's get to our next management. Let's focus on Brigade Enterprises. Now, the company has entered into a sale deal for acquiring around 6.5 acres of land in Chennai to develop a residential project. To understand more about this and then focus on other aspects, we're joined by Atul Goel, the CFO of Brigade Enterprises. Hi, Mr. Goel. Good morning. Thanks so much for joining in. Well, give us a few details. What is the cost of acquisition out here? And give us some kind of details on the, the timeline of this launch, what kind of a project will it be, and sales potential.
Good morning. As you said in your introduction, that it is a 6.5 acres land. So it is a corporate land which we have bought, and it is on the main OMR road. We already have a very, very big development there with GIC, which is a World Trade Center in Chennai, and we also have a residential attached to it. So it's a very prime property. We have acquired it for 145 crores. And we expect around 1 million or so development there, which will be mainly on the residential side.
At what price,
and
Mr. Goel?
Yeah.
At what price? So, I mean, 1 million square feet of saleable area. At what price?
Yeah. So it's very difficult right now, but you can say around 10,000 is the minimum. But by the time we launch, it should be much more. So around GDV will be in the range of 1,000 crores or so.
Okay.
Okay. Any more land buys that you're looking at the moment, and what is the areas, what is the geographies that you're looking to buy land at? What is the amount, the corpus that you have outlined for this?
So see, we are looking for land, and as the sales are very good in residential, we are looking, we recently bought an auction in Hyderabad for 9.5 acres or so, which was for overall 660 crores. So we are trying to take land more in Bangalore, Chennai, and Hyderabad to spread our basket, so that everywhere we can do the launches. Right now, the maximum launches and sales are from Bangalore. So everywhere we are buying, we are looking for land and trying to take good land. Overall, if you say, we should do around 500 crores per year of land acquisition, based on how the market demand is there and how the sales go ahead in coming quarters.
Okay, so you already have a 340-acre land parcel in Bengaluru currently, right? How much you're planning to grow it by? And what's in the pipeline for, say, the next 6 to 12 months in terms of new launches?
So in new launches, we are planning around 7.5 million or so. Yes, there has been some delay in approvals, but definitely we are targeting around 7 million or so launches. There can be some delays because there are some launches from Chennai as well. So based on the approvals and the RERA approvals, we will try to launch that much. Of course, Bengaluru will always remain a mainstay for the company. We are going ahead and doing more and more acquisitions in the form of JDA or in the form of acquisitions. But see, our prime focus today is Chennai and Hyderabad, because we want to increase our focus in both these cities. Chennai already we have bought land of around 12.5 million or so. Hyderabad we have started. So focus is on all the three cities, and Bengaluru will always be a focus because it is a prime focus for the company.
All right.
Just one thing, Mr. Goel, in all these cities, 3 cities, could you clearly tell us how much is the saleable area that you're sitting on at this point? Chennai,
So
Hyderabad, and Bangalore? Yeah.
Yeah, so right now in Bangalore, it is around 33.3 million. In Chennai, it's 12.5 million or so, and the rest is others. Of course, now Hyderabad will also get added to it, which will be in the range of 3.5 million of development in Hyderabad.
All right, Mr. Goel, there have been a lot of NRI investments in the real estate market. Are you observing that sort of a trend as well in your projects?
Yes, some NRI investments are definitely there, but I would not say that it has been a increased demand. Yes, demand is there. Bengaluru as a market, people like to settle here because of the talent which is there. So demand has increased, but I will not say to a very, very great extent.
But you know, I recently visited the city and I realized that there is not only rapid urbanization in Bengaluru happening right now, but there's also a big destruction of the green cover, which is, of course, another issue altogether. But I take your point that, you know, things are definitely picking up. But that's on the residential side, right? Tell us a little bit about the commercial side of things. This time, again, commercial demand was a bit on the weaker side. What is the occupancy like and what is the way forward for you?
See, for us, the main commercial demand and the commercial properties which we have are in SEZ, and of course, SEZ has been struggling all over India. Non-SEZ, we don't have any vacancy; everything has been leased out. So in SEZ, yes, there is an issue. We have around 1.2 million, and of course, this talk of recession in US, which has never come. So it is. I don't know how the companies have been delaying their decisions to rent in these SEZs. But of course, we are looking a lot of demand from the existing clients, because maximum of our clients are global capability center CG, and they are looking for good expansion. And I think we should be able to fill this 1.2 million in next 4 quarters.
So can you give us the numbers? I think in FY23, your lease rentals were about 750 odd crores. Where will it be like in the end of FY24? And you have about 8.5 million square feet of operating commercial portfolio. Do you plan to grow this further? Just those 2 numbers, if you can help us with.
Yeah. So rentals should go in the range of 850 to 900 crores this year. That is what we estimate. And of course, for additions, we have one project which is called as Twin Towers, where we have 1.3 million square feet, which will get completed next year. And definitely it's a non-SEZ, maybe year end or Q1 of the next year. So that is the main lease area which will be launching in the market. There is some 1.3 million development in Whitefield also. So that is also coming up, but that will take time of at least 2.5 years to come up.
Okay, thanks very much, sir. Appreciate you joining in here on CNBC-TV18. The market's looking up and you're looking for land, building it out, and I mean, tapping into that demand, which is across cities looking very, very robust. Well, thank you for joining us. We'll be around 80 points.
Yeah.
Sorry.
Just one point, Prashant, on Jio Financial Services. At the start of today, there were more than 15 crore shares that were pending for sale at the lower circuit. That number is half right now. It's down to less than 7 crores odd. So at lower circuit, there's a lot of buying on Jio Financial Services. Just thought we'll point that out. On a day-to-day basis, we're seeing very large selling out there. And that's a bit of a problem point for the Nifty as well, because it's dragging the index by around 10 points. So just keep an eye out on that. Gradually, maybe a couple of sessions or so, we could see that release.
That should get exhausted, absolutely. Stocks were 200, almost 200 rupees now, after making it to the market at about what exactly, the 262 or so. So that's Jio Financial Services. Let's shift our focus to the financials space, right? And this is a very specific focus on the personal loan segment that we're going to sort of talk about here. During CNBC-TV18's Banking Transformation Summit earlier this week, Jairam Sridharan, Managing Director of Piramal Capital and Housing Finance, said that we are just months away from the next credit cycle. He was, to be sure, referring to the unsecured portion, not the entire sort of banking system or loans made everywhere, but to the unsecured segment, personal loans. Ramesh Iyer, Vice Chairman and Managing Director at Mahindra Finance, kind of countered that and almost said, well, that perhaps is not what he's seeing in his business. And Mahindra Finance, of course, is largely rural, but, I mean, it's not unsecured. Their business is largely secured. I want to play both those sound bites out for you, and then we'll invite guests to talk about this.
I think we've all got to imagine that whether we can see it coming or not, a credit cycle is coming, right? And now, which part of the segment it might come from?
How many years out, you think? I mean, best guess.
You use the wrong word there. I would say months. you look at the data. What do we see right now at the industry level? We see secured lending products, risk continuing to come down across the full industry level. You see personal loans products, risk was coming down for a long time and now it has stabilized. And you see credit cards, it was coming down, it stabilized, and now it has started going up. So credit cards has gone up. Within personal loans, which look stable, if you split it up into small ticket and large ticket personal loans, small ticket personal loans risk has already gone up compared to 6 months ago. So credit cards and small ticket personal loans risk is already up. MFI just went through a cycle 2 years ago, so they're not going to see any problems for a little while. But the semi-urban, urban markets, unsecured lending, is risk going to be remain where it is today, 6 months from now? I would bet serious money against it.
We've always believed that in this cycle, you have to be very sure and clear about circumstantial and intentional defaulters, right? If you've chased, you've kind of chased growth and you've lent to people, and you believe that, their ability to repay itself is doubtful, of course, they will all have this problem whenever such cycles hit. And if you look at the book, most of the people book, what is NPA today are actually circumstantial NPA, because if it is an intentional default, we've already taken action against it. Either we have taken back the asset and settled it, or we have provided for it and be done with it. And also look at this cycles, how the whole mechanism works. 90% of the people in this country borrow and they are responsible to repay. You don't even need to follow. It's the 5% who require some nudging, some follow-up, some reminder they pay. The whole struggle is for the last 5%.
Okay, let's welcome in the guests then. Saswat Guha is Senior Director Banks at Fitch Ratings, and A.M. Karthik, Vice President and Group Head Financial Sector Ratings at ICRA, is now joining in. Gentlemen, great to have both of you here. Appreciate it. Saswat, let me start with you. You heard Jairam very clearly outline that it's not years away, it's months away, not especially, but the unsecured credit segment. Do you, first of all, agree with that? You've put out some numbers recently. You've been talking about this. So tell us, what is your assessment?
Yeah, morning, Prashant, and thanks for having me. Yeah, we have been talking about it because as a rating agency, we try and look for potential risks in the system. And as we all know, while the banking system, since I primarily look at banks, has been sort of de-risking for a fair number of years, particularly when it comes to, non-retail. But I think on the retail side is where the risks have been built up. Of course, a large part of that has been driven by secured retail. But as we know, in the last couple of years, 2 to 3 years, I would say, is when unsecured retail has started building up. And I think that pace has picked up momentum quite significantly in the last year or so, especially with interest rates and going up and to a certain extent, margins questionably coming under pressure because of its impact on funding costs. And now, if you look at, the scenario on balance, at a system level, personal loans is roughly about 8 to 9% of the system. For the banks we look at, which are primarily the large banks, I think most are within, say about 1.5 to 2% of their loan book. Of course, there are those where the numbers are significantly higher than that, in the range of 8 to 9%. Private banks, I think one private bank is there. There's one, the largest, state-owned bank also has numbers similar to that. But the question here is that one, of course, is that the credit demand for personal loans in itself has increased. So there is always that risk of over leveraging, one, and two, the pace at which the portfolio has grown, even though from a lower base, sort of would signify a large degree of unseasoned risk. And the second challenge with unsecured loans is on the visibility around end user funds. So, in India, personal loans has always been in demand for, families looking to fund, say, life events or basically economic events. But the limited visibility around the end use sort of makes it very difficult to distill whether the funds that have been given in recent years have been used, one, for economic activity or conspicuous consumption or even speculative market activity. And I think that is the challenge there.
So, Saswat, you're saying, I completely sort of take your point and well explained. So, 8 to 9% of system loans are, you'd say, personal loans. For banks, that would be between 2 and 3% generally. There would be variations, but overall, it would be between 2 and 3%, right?
Yeah, for the large state-owned banks, that's roughly where it is at the moment, say barring State Bank of India, which is probably higher. But yeah, the portfolio itself has grown. I mean, on an average, it has doubled. But then there are banks where the portfolio has grown by nearly 4 to 5 times in the last 2 to 3 years.
And to that, and got that statement which Jairam of Piramal made, we are months away. So I want a yes or no from you. Do you agree with that?
Well, see, it's very difficult to conjecture on the timelines, but like any portfolio, I would agree that we are probably going to see a cycle in this space sooner than later.
Okay. AM Karthik is also sitting by very patiently, Vice President and Co-Group Head Financial Sector Ratings at ICRA. Karthik, thanks for joining in. You know, I want to talk a little bit about the point that even Saswat was making about the growth in personal loans, right? If you just look at the data, in June of this year, personal loans grew almost 21%, supported by good growth in housing and vehicle loans. What is the data suggesting to you in terms of what the future could look like? Is this something that is sustainable, and what are the trends?
Yeah, good morning. Thanks for having me. I agree to the points that Shashwat made broadly, but there are other mitigants which do support this growth. One, you do have a very strong digital stack which supports data, which is fueling essentially the credit decisions. Otherwise, there is a good amount of seasoned borrowers that we have on board, both for NBFCs and banks, where there is a good amount of leeway to extend personal credit. These are unsecured in nature. And most of these loans are typically priced in a way that they factor in the extent of the possible losses. What we see in typically the non-bank space is that, while the headline numbers that we see from the entities getting reported would be much lower than what we typically see for other asset segments. But the write-offs that these loans witnessed is substantially higher. So we expect, or historically the data is that the losses that we see in this segment is about 2 to 4x of what we see in the overall segment otherwise. And on a steady state basis, we expect these losses to be 4 to 6% on a cohort basis. When I say cohort, it's essentially a loan of 100 is disbursed, there is a possible loss of about 4 to 6% of that loan. Entities are aware of these risks, and the growth that we are seeing of 20% plus is supported by the facts that I mentioned: digitalization, cross-sell, upsell, so on.
Karthik,
but the pricing of the loans is where the play is, and we expect the credit cost to be higher. We expect the growth also to remain high, because that's where there is a diversification and that's where there is a possibility for growth to come in.
So the high cost that these come along, right? I mean, very high interest rates. That should act as a buffer for any loss, and that's, you're saying that entities are well aware, so it's kind of balanced. So you don't agree we are running into any kind of problem in the next few months, as Jairam there sort of pointed out?
So I mean, the timelines are again always debatable. Any sharp credit up cycle, one would expect something to happen towards the end of it, but it's very difficult to estimate whether when the down cycle starts or even starts showing. Of course, we look at some early warning signals, right? So there are some early warning signals which are cropping up at this point in time, where we will try and see if the loan cycle, wherein whatever I mean by loan cycle is essentially that the disbursements are growing at a much higher pace, and the loan rundown is happening slowly, and the disbursement is much higher than the AUM growth, is something that one watch out for.
Got it. Karthik, do you have the figure for what is the exposure at a system level across the board for NBFCs, unsecured segment?
So overall, NBFC, the unsecured segment, which will include the MFIs, is estimated to be about 5 lakh crores. This is on the base of about 40 lakh crore of the NBFC overall loan book. Within this 5 lakh crore, 1.5 lakh crore is towards the microfinance loans. And the remaining 3.5 lakh crore, we would split it as 2.5 lakh crore towards personal and consumption loan, and about 1 lakh crore towards the unsecured SME loans. This is a position March 23.
So we should take about 3.5, right? 3.5 lakh crores. So
Yes.
around 5%.
3.5 on 40, so 40 lakh crore. So that's about 9%.
Okay, on 40 lakh crores. Okay, got it. Got that. So, you began, Karthik, by saying that because there is, more digital footprints, data and all, it helps in reaching the customer faster, but does it allow in helping making credit decisions better? That is the question which we will only find out, right, sometime down the line. But certainly there are more digital data points out there on the basis on which these lenders, NBFCs, rely on, not just the CIBIL score. Saswat, any additional points you want to make, off of what Karthik said or otherwise?
No, I think I do appreciate and do sort of agree with the broad points I think Karthik had made. But I like to sort of pick up on the last point of yours, Prashant, which is, to what extent, this sort of digital engine will actually, go in terms of mitigating risk. And the answer is we don't know. I think what we do know is that generally, if you look at credit institutions or banks for that matter, they've had a bit of a checkered past. And a lot of these enhancements, so to speak, have been made in the last maybe 3 to 4 years, which is sort of now helping these banks build that book. So we'll have to wait and see whether, some of these sort of digital data stack, whatever you might call it, is essentially, going to actually help mitigate risk through the cycle. The only other thing I also wanted to raise here is that, there is also an indirect exposure that banks have through the NBFC route. So while if you look at
NBFCs
the average,
borrow from banks, borrow from banks basically.
Bank exposure to NBFCs, because that percentage has gone up a fair bit since 2018, and more so through the pandemic. But even though, say, banks individually, their ticket size may be significantly higher than the odd 50,000 crore that has been, that keeps getting flagged as very high risk. But the thing is that we don't know, to what extent banks are having exposure to those NBFCs who are actually giving out those small ticket loans where those risks are significantly higher. So if there is a cycle, do we feel that it will necessarily destabilize the bank balance sheet? The answer is probably no. But I think it will certainly affect the sentiment that we're seeing at the moment. So, and I think that's also one of the reasons perhaps why, we have seen the regulator also making a lot of commentary on this well in advance, of the cycle, because, there are clearly risks that perhaps even they are seeing, that probably they want to avoid manifesting.
Okay, got it. Absolutely. The RBI has come in and said some stuff. I think Bajaj Finance made some comments in that regard. Chola has made some comments. So we'll see how things go. But thanks very much for joining us here on this program, Saswat and Karthik. Appreciate it, you guys joining in. Well, the B20 Summit India 2023 is underway in New Delhi. Let's cut across to N. Chandrasekharan addressing the summit.
Navigating through 3 important fundamental transitions. The first is the digital and artificial intelligence transition. The second, energy transition. And the third, a global value chain, supply chain transition. India is extremely well positioned to lead in all the 3. A sentence on each. On the digital and AI transition, India over the last decade has created a fantastic digital infrastructure and has proven public services delivery at large scale. All of us who live here make our payments only digitally. I don't think any of us carry cash. Not a day goes without looking for multiple OTPs. And that's the kind of success we have had, and with a strong talent base, it is very natural for us to make and lead this transition. On the energy transition, most of the energy we need over the next 3 decades, that's almost 2/3 or 3/4 of the energy we need, we will have to create. So India will be creating the new energy for growth and will not be substituting the old energy. So that makes it easy to transition, and more importantly, that makes it most exciting and economically much more interesting for all investors. And the third, the current geopolitical shifts and a large domestic market in India and the global presence of companies in India and the strong talent base that we have makes it very compelling for India to lead the creation of an alternative supply chain. So India has many things that goes in its favor. Also, the transformative government initiatives such as the public digital infrastructure, the PM Gati Shakti, the PLI incentive schemes, the Startup India, reduction in corporate taxes, and many of these initiatives are helping India sustain the fantastic economic momentum.
Okay, well, that's N. Chandra, Chairman of Tata Sons. Let's look at Jio Financial Services, where, as Nigel was pointing out earlier, a lot of the selling at lower levels when it was limit down was getting absorbed. The outstanding sell orders were reducing sharply. And there you go. From being down 5%, it's actually jumped about 5% higher. So it's a full 10% swing. And the selling got absorbed. And we've got a big move which is coming up on the upside very, very fast there. So, I mean, in terms of just the positioning, etc., there's not very much positioning, at least on the long side at all. So it's in that sense, it's light, that technical adjustment as well. But the selling got absorbed and some buyers are showing interest. Of course, the Reliance AGM is on Monday, right? I mean, 2 p.m. onwards on Monday is the Reliance Industries AGM. So that is a big event around which I think there will be a fair bit of people will look to it to get any indication in terms of what the promoters think of the business and the financial services side, etc. So that's Jio Financial Services out there off the circuit and up right now. Mitesh is with us. Mitesh, hi. Welcome back. Quick word on the sort of index here, 60 points lower off the lows and your fresh trades.
Morning, Prashant. See, earlier in the day, I spoke about that, closer to 19,250, 19,200, try to attempt longs. We got a low of around 19,260. I think that level is still holding on, which means that we are still in a range. But around the lower end of the range, you would want to attempt long trades. On the stock side, also I have 2 buy calls. Mastek is something, which is broken and made a fresh high. So buy there with the stop below 2,200 for targets of 2,400 on the upside. And amongst the banking names, Bandhan Bank is showing a good recovery. That's a buy with a stop at 233 for targets of 250.
Okay, well, Mitesh, thanks very much for that. We'll take a quick commercial break here. We'll come back and check on what's happening in the world of commodities. Manisha will be with us to help us do that. Stay with us. Okay, welcome back. Markets seeing some recovery and we're down about 60 odd points or so. Let's shift focus to the commodity markets. Manisha is here with the commodity, which is top of mind. Manisha, morning.
Thank you for that, Prashant. Well, I'm looking at rubber prices, and the first half of this year is nothing to write home about. We've seen rubber prices actually trade in the negative there. But the last 1 week, we've seen prices trade up nearly 3% on the higher side, and we're trading at a 6-week highs right now on the international markets there. The Chinese demand on ground seems to be picking up, and so are the reports suggesting from European Union as well, where the automobiles and the tire sector demand seems to be picking up, and that sentiment is coming in case of prices here. There also is an interesting report from Association of Natural Rubber Producing countries, which suggests that for the month of July, on a year-on-year basis, they have seen production gain up by 2.1%, but the consumption has increased much higher by 3.2% there. For the overall year as well, they are anticipating higher numbers there. So for 2023, this is on an year-on-year basis. The demand is expected to gain up by 14.6, while the consumption is expected to gain up by 14.7 million tons there. So strong numbers coming in from that one as well. The Indian rubber production, in the meanwhile, that report is also out. So while 8 lakh tons is what we did in the previous year, this year the production is expected higher at 8.4 lakh tons. But even with that, because India consumes more than what it produces, so 5 lakh tons of an import is also what is being factored in. India actually imports rubber from Thailand, Malaysia, Sri Lanka and Vietnam, where the rubber prices are slightly on the higher side. So some imported inflation also is what Indian markets are working with.
Okay, well, thanks very much, Manisha, for that. Interesting as always. We'll take a quick commercial break here. On the other side, our special segment is the economy. Lata will be joined by Dan Struin, who leads oil market research at Goldman Sachs to discuss the global economic outlook and the impact of volatility in oil prices. Stay tuned.
Welcome to It's the Economy. Brent crude prices have fallen for the second straight day despite lower than expected US inventories. Now, this could be because of subpar purchasing managers index numbers that are flowing in from Europe, Britain, Japan, and the US itself. In any case, at the moment, more than the data, all eyes are on what Fed Chair Jerome Powell may say at Jackson Hole, which is, of course, the annual meeting of central bankers at Jackson Hole. If Powell is even mildly more hawkish than expected, yields and the dollar can jump and commodities like oil can face the repercussions. To understand the nuances of the crude market and the US economy, I have with me someone who is proficient in both, Don Struven, who leads oil market research at Goldman Sachs, and until recently, he co-led the Goldman Sachs Global Economics team as well. So, Don, thank you very much indeed for joining us. I want to come and ask you a lot of questions on the US economy and what is expected from Jerome Powell. But before that, you are sticking with your forecast of $86 per barrel for crude up until December this year. Why do you say that, considering that growth data is coming in so weak?
Yeah, thanks a lot for having me. It's absolutely correct that oil prices have edged down somewhat over the last few days on the back of renewed growth concerns coming out of Europe and China. That said, in the prior 7 weeks, crude oil prices, Brent prices rallied by about 15%. And at this point, we're quite a bit closer to our year-end target for Brent of $86 per barrel. Two reasons really why Brent has rallied for most of the summer. Number one, we think that the global oil market has finally returned to deficits after a year of surpluses. We returned to deficits both because global oil demand, we think, reached an all-time high in August of above 103 million barrels per day, and because Saudi Arabia cut production in July. Second reason for the rally is that macro sentiment among oil investors, which was excessively pessimistic for much of the year, has normalized and has recovered along with positioning. From here, we expect only modest gains because we believe that the oil market will remain in sizable deficits worth almost 2 million barrels per day on average in the second half because of robust demand growth, anemic US supply growth, and strong supply discipline from OPEC+.
Okay. Don, I'm going to come back to oil market fundamentals of demand and supply for 2024 as well. But before that, the big event that's staring at us in the face, the Jackson Hole speech from the Federal Reserve Chairman Powell. What is the base expectation and what can move the needle for the crude market?
Yeah, so our Goldman economists don't expect any major change in messaging from Chair Powell, in part because we still have important data releases ahead of us, including jobs numbers and inflation numbers. I think big picture, the message will likely be that the Fed is going to stay focused on bringing inflation down. But at the same time, this urgency to hike, we think, has dropped significantly, both because the level of the funds rate is now quite high, and because we have made very substantial progress in terms of core disinflation.
There is, of course, success in core disinflation. But what's the Goldman view on growth? Aren't recent US economic data still pointing to a fair degree of resilience? What's your own estimate? Does a soft landing look still very likely?
So the Goldman House view has been for a while that the US economy is on track for a soft landing, and the confidence in this constructive, out of consensus view has really grown significantly over the last few months. We now believe that the probability that the US economy enters a recession in the next 12 months is just 20%, well below consensus. Three reasons for our constructive growth views, where GDP growth is just above 2% this year, just below 2% next year in the US, because of solid momentum, because the fundamentals look good, real incomes are still rising, and the drag from monetary tightening on growth is actually fading. And so if you combine that with all the progress on core disinflation, which eliminates the need for the Fed to hike further in our base case, putting that together, I think it's a pretty solid case for the soft landing for the US economy.
Okay, that's also a pretty solid case for yields remaining high. So let me come to that, Don. Though you would be looking at crude prices, crude prices are willy-nilly influenced by the US yield level as well as by the strength of the dollar. Now, what has surprised financial markets, or so it seems, is the very sharp rise in US yields in the month of August. 3.5% in the 10-year in June, 3.7 in July, and 4.3 in August itself. What is your sense? Do you think that even if core inflation data came in lower, yields could remain higher because of what Fitch pointed out, continued high fiscal deficit?
Yes, so our rate strategists had been looking for a while for the US 10-year yields to rise to around 4%, both because we viewed the pricing of cuts in 2023, strongly related to the consensus view of high recession risk, as excessive. And that cut pricing in 2023 has significantly reduced. Second, we have been skeptical for a long time now about this idea that the neutral rate, the long-run equilibrium interest rate, is as low as markets believed it to be in the last cycle. And as you point out, on top of that, larger fiscal deficits in the US, but also in most other major economies, should put some upward pressure on term premia and on long rates. That said, we believe that the rising rates has now run its course, both because we believe that investors may be overestimating the impact from increased treasury issuance, and because we think that the BOJ will not exit yield curve control for the remainder of this year.
Okay, got that. So your rate strategist is estimating 4, but maybe 4.3 will not hold for too long. Okay, time permitting, I'll come back to that. Are they also expecting a strong dollar to continue? I mean, we've seen dollar go north of 103 from sub 99, the dollar index, that is. Does the dollar remain strong? Because that will be an impact on crude prices.
Yes, absolutely. A strong dollar reduces demand for oil and commodities more broadly outside of the U.S. because most commodities, including oil, are denominated in dollars. The dollar view of Goldman Research is nuanced. Big picture, we're looking for shallow dollar depreciation. Shallow because the U.S. economic outlook is still solid. And we expect the Fed to keep rates at current levels until probably the second quarter of next year. I think the main reason the dollar has appreciated over the last few weeks is renewed growth concerns coming both from China and Europe.
Okay. Well, now let me come back to your crude forecast for next year. Considering that the US economy also is going to slow down and China is not really living up to the promise of even normalizing growth, shouldn't crude trend lower in 24? I think your forecast for 12-month forward is even over $90.
Yes, so we look for crude prices 12 months ahead at $93 per barrel for Brent. The main reason that we expect oil prices to edge somewhat higher really is that we expect the oil market, which is now in a very large deficit, to stay in a sizable deficit next year, worth around 600 KBD on average for next year. Why do we look for somewhat tight oil markets for the next 18 months? Number one, we look for solid oil demand growth. In fact, we expect global GDP growth to equal in 2024 to equal what it is this year, around 2.5% in both years. So we're not really looking for a slowdown. And on the supply side, we think that U.S. production will grow at only a very anemic rate because of strong capital discipline in the sector. And last but not least, we think that OPEC pricing power is greater than it has ever been. And so Saudi Arabia and its partners, we think, will only very gradually bring barrels back to the market. And we'll only do that if prices move in line with our expectations. And of course, also if prices were to exceed our constructive forecast for oil prices.
Okay. Well, that's not exactly good news for a country like India, which is a net crude importer. But be that as it may, just a few more shorter-term questions. You said your range, your your crude forecast for December is $86 per barrel. But what is the range? In the meanwhile, can we see the current downturn take it even below $80? What's a likely range for the rest of this year?
Yeah, so we think that the likely range for oil prices this year is sort of 75 to 95. We think that volatility in oil prices, which has come down sharply year to date, will remain fairly muted. On the demand side, because we think that recession risk is lower than widely believed, and on the supply side, because we think that OPEC Plus and Saudi Arabia will really manage the speed at which they bring back barrels to the market as a function of fundamentals and as a function of prices.
Okay. Thank you very much, Dan Struan. That was most useful a conversation, not very helpful for a net importer like India to hear that crude would go to over $90 next year. But I think what's music to our ears is that Goldman Sachs expects growth to continue to remain into 2024, at least as strong as in 2023. Jackson Hole, of course, the base case is that Jerome Powell will not sound more hawkish than the market is preparing for. Any specific words we have to watch out for, Dan, from Jerome Powell?
I think a big question is whether we get any signaling on the bar to keep hiking in terms of inflation numbers or perhaps any upside risk from a reacceleration in growth above trend.
Okay. Oh, yeah. We'll watch out for that. Thank you very much, Dan Struan, for spending time with us. Well, that's the word from the expert from Goldman Sachs. Let's watch out. What is the bar for hiking rates? He did not say the bar for cutting rates at all. Now that's out of the question. Bar for hiking rates. We'll watch out for that on Friday evening, our time. That's it on Bazaar. Up next is Chartbuster.